Good evening. I'm Dr. Joel Silverfield, President of the Hillsborough County Medical Association. Welcome to all of you and good evening. We're very proud and excited tonight to bring you a financial seminar. As an older physician, I hope that our younger listeners will take my advice, and it's never too early to get started on your finances. It's something, if you get into good habits early, you won't end up like me, old and still having to work all these hours. We're very lucky to have two excellent people tonight. We have the Physicians Wealth Management Seminar Group has been supporters of the HCMA for several years. They've been good friends to us. They're part of the Jensen Anderson group. They're a financial planning firm that basically has been serving physicians for 30 years. Michael Jensen is a certified financial planner and also a family business specialist. In addition, he is an adjunct professor at the USF Morsani School of Medicine, and of his own time gives seminars to our young physicians trying to help them get started in the right way. Jeff Anderson is with us tonight. He's a certified financial planner as well and has much good advice for our doctors. So tonight, we're very lucky to have these gentlemen here with us, and please listen in. Thank you.
Thank you.
Thank you, Dr. Silverfield. Thank you very much. I'd like to make a couple of comments before we start this conference. And the first thing is that when Jeff and I teach classes, we use a conversational method of education. We truly believe and has proven that we learn by asking questions. The more questions you ask, the more that you will leave this conference with. So please ask questions. I realize it's a little bit more difficult asking questions on a Zoom meeting than if we were in person, but please ask, please do that. And you'll also notice that as Jeff and I speak back and forth as we're teaching this class, we do it in a conversational method. And we hope as we're going through this, that we're asking questions if you're not, and bring up certain points that are very important. So that's the first thing I'd like to say. The other things that I want to say is when you review these classes and you go over them, you always learn a little bit more. So that's my comment. Go ahead.
All right. Let's get started. All right, Mike, you're up.
Okay. You know, times have changed. You know, the famous saying, back in the day. Well, back in the day, when our parents, when they would think about retirement, it really wasn't that complicated a thing. They would usually work for the same company or same firm for a lot of years, okay? And that company would probably have some type of retirement plan, and maybe small. But at 65, they'd retire, okay? And most probably by 75, they were dead, okay? So it wasn't that complicated. You know, they live on Social Security, maybe a little retirement plan at work, but it wasn't complicated. Things are changed. Things are different. People don't work till 65 and die at 75. People, you know, the fastest growing age group, as you know, are people over 100. But today, there's a whole different type of planning, and people will work longer. Jeff, do you have some comments?
Sure, yeah. What's happening is people are living longer. So, you know, historically, retirement planning, you only had a plan for 10, 15 years. Now we're looking at planning for 20, 30 years, which brings on a whole nother dynamic when it comes to planning. So some questions to consider would be, you know, what's my primary source of income during retirement? Am I going to work part-time during retirement? What age do I want to retire? Is my partner on the same page? Who should my partner speak about financial advice? Do I have an advisor? So the first step is really in this book, when you're starting to develop your retirement plan, would be the personal partner exercise that's in the book. Okay, well, and what is this? Well, it's a great exercise to go through. If you're married or have a partner, it's great to do individually. and then compare the answers to each other. So what's the point of this exercise? Well, the point of this exercise is start to open up the dialogue of what do we really want to achieve when we retire? What's really important to us? Do we want to travel? Do we want to play golf? Do we want to go and see the grandkids a few times a year? Where are we going to live? Are we going to have a vacation home? This requires a lot of planning, because the other aspect of this is that you're not working anymore. And now you're going to be together an extra 40, 50, 60 hours a week. And that can honestly present some problems as well, because you're not used to that dynamic. So this exercise is a great way to start to open up the dialogue, starting to look at retirement through the lens of, okay, I'm here now. What do I really want to achieve, and how am I going to get there? Mike?
Yes. Physicians are definitely an entity unto themselves, and they have certain characteristics when it comes to retirement. Because one of the things that Jeff brought out is, when are you going to retire? Well, you know what? It depends if you're asking a physician this, it depends how old they are. When we have the young fellows and residents come out and we ask them, well, when do you want to retire? They're all saying, I don't know, 45, 50, maybe, something like that. With that young group, the middle group, those doctors, they're going to say, well, I think I'm going to retire when, I don't know, 60, 65. Okay. And then the older doctors, when are they going to retire? They're saying, I don't know, 65, 70, and then they don't want to retire. They just go out slowly, thinking they died and went to heaven means they're not on call. That's it. And the other thing is, a reason that they'll slow up as they're leaving. By the way, it's not that they don't have the money, okay? They will have the money. Most physicians will, okay? They don't slow down and they don't go out sooner, because there's, to a degree, a physician, as in other professions, they identify themselves as a doctor. And I literally have doctors ready to retire. They don't want to retire because their identities become they're the doctor when they retire. So physicians don't retire at 50, 55. And Jeff, gosh almighty, you really notice, we have plenty of people can retire that just don't. So you have the blessing of being able to choose the age that you want to and the conditions. And what'll probably happen is you're not going to retire overnight. You're just going to fade out and cut down on the hours. So that's a very important thing that you have to think about with the retirement. And that's probably the process you will go through. And Jeff brought up a very good point about retirement. There's a standard CFP line that says, I saw your marriage vows, and your marriage vows said that you married for better or worse, but not for lunch. Because what are you going to do? And Jeff brought this out. What are you going to do when you have to stare at your partner instead of the two of you going out to work or whatever? But retirement now is a different game, and it's making sure that you have the assets to do what you want to do, because you're going to live a long time and you'll have a heck of a good time with proper finances. Go ahead, Jeff.
Yeah, so the first chapter in the book is really what's called lifestyle planning, and that's figuring out what you want to achieve when you retire from a lifestyle planning perspective. The exercise in the book is a great exercise to go through to try to open up the dialogue with your partner, spouse, and figuring that out. So the new retirement planning process kind of looks like this. Number one, determine the outcome you want to achieve. We just talked about that. Lifestyle planning, that's really the first stepping stone of developing a good retirement plan. Mike, you want to take these other numbers?
Yeah, and you talk about the education, where the folks on this Zoom meeting right now are actually doing that. You are educating yourself to make informed decisions. So that's a plus. A very important thing to do is you need to analyze where you are. You need to take stock of what's going on. You need to draw a plan. Call it a financial plan, but you need to have a plan that gives you a roadmap of where the heck you want to go. If you don't have a map, you're not going to get to the place. So you've got to stop back and see, what do you have? What do you owe? what's left over, and how's that money going to last through my my retirement or partial retirement years. And that is very important. I personally think that's the most important thing of anything that we say here tonight. You've got to have some type of plan to follow. Okay, Jeff?
Yeah, and then, once you develop the plan, implementing the plan is crucial. A lot of times people will go through all the work of developing the plan, but maybe they need to save X amount of dollars in order to hit their target retirement number, but then they don't go and do that. Or maybe on the estate set piece, they've drawn up a trust, but they don't put the assets in the trust. So things like that, the implementation of the plan is just as important as the plan. And then reviewing the plan over time in the form of an annual review, at least once a year with your advisor, is imperative. Things change and you need to stay on top of that, which we're going to talk about here in a minute. So reviewing your plan. So develop the plan, implement the plan, and then review your plan at least once a year. That's the new process. Okay. This is just, we just added this. I want to just talk about what the expectations are for the rest of this class. Section 2, we're going to cover tonight. Section 3, we're going to get into as well. We're going to cover taxes tonight as well. We've got Jason Hamlin, who's a great CPA. He's going to talk about taxes tonight. We're also going to do the estate planning section tonight as well. Next week, we'll be doing retirement income sources, which is Social Security, IRAs, 401ks, distributions, which is how to execute your RMDs, how to take money out of your retirement accounts. Well, we'll be covering investments next week. And then we'll also be covering risk management, which is, disability, life, long-term care, all that stuff. And then we'll wrap up. Okay. So that's
we'll also cover asset protection.
Asset protection. Yeah. Another big one. We'll be doing some of that tonight as well. Okay. So that's just kind of an outline for the class. So let's jump into some planning. This chapter is going to cover the variables that are involved in when you build a retirement plan, what to watch out for from longevity risk, which is living too long, and also inflationary risk. Mike, you want to talk about inflation?
Yes, inflation. Over the past 28 years, inflation has averaged between 1.7 to 2.4%. When we run our retirement numbers for our clients, we always use inflation 30% higher. We run it 3%. And we just 8 weeks ago, we switched using an inflation rate of 3% and we moved it to 4%. That's 100 basis points. That's a huge jump for us in this profession when we're doing inflation, because inflation will eat your dollars. $100 today is not what $100 is going to be in 10 years. The destruction that inflation can have on your lifestyle is tremendous if you're not prepared for it. You've got to be prepared for inflation. Jeff, do you want to comment on that?
Yeah, you know why inflation is such a big deal is because people are living longer. This chart here shows, this is just life expectancy. So current age, a male 65, his life expectancy is 82. Now, a lot of people will plan for life expectancy, but that's flawed because that means that's an average. That means 50% of people are going to live past 84, 83 years old. Okay. So you really want to plan to age 100. So if you're 60 or 70 years old now, or 50 years old now, that's 40 years of inflation that plays a role in your plan. Okay. So that's a big deal. So let's just take a look at some numbers here that show how powerful this really is. So at a 3% inflation rate, $1 today, 30 years from now, to buy the same exact goods and services, you need $2.43. At 4%, you need $3.24. So that's a huge, huge increase. I mean, that's a big deal. And inflation's sneaky because you might retire at 70 and you're on a fixed income and you're pulling in your money. And then all of a sudden, 10 years from now, you have to take an increase in those monthly additions to your bank account because things are getting more expensive and it will slowly creep up on you. So you gotta do an annual review to make sure you stay on top of this. So let's look at some numbers. $5,000 today to buy the same goods and services 30 years from now, you would need $12,000. All right. So let's say just for
that number again, Jeff.
That's $12,000.
Everybody hear that?
And that's just at 3%. So If I wanted a $10,000 a month income need in today's dollars, I would need $24,000 a month to replicate that same spend need 30 years from now. So that's a big deal. You need to plan for that, right? Now, a lot of people will say, well, I can just reduce my expenses. $5,000, you'd have to reduce to $2,000. That doesn't work. So that's not an option. You're not going to be reducing your expenses in retirement. I don't care what anyone says. The expenses are going to still be there, right? So this one, we added this slide. This one's just really interesting. So let's say I made an investment and I made 5% on my money. Okay, so I made 5%. It's taxable at 24%. So if that $5,000, I made a $100,000 investment, I made 5%, that's $5,000, right? I net after tax $3,800. So that means my account is $103,800. If I back out a 3% inflation, and my account is now only worth $100,686. So out of a $5,000 gain, I'm only netting $686. Okay, so what this shows is real life examples of inflation eroding your returns. All right, so this helps you try to gauge your risk tolerance when you retire and things like that. This isn't to depress you too much, but this is kind of show you a real life example of taxes and inflation, how it can impact your actual returns.
And that's 3% is low, folks.
Yeah,
It's low.
exactly.
Okay.
So Mike, we're going to talk about how much do I need to retire? How do I figure that out?
Yeah, let me make a couple
absolutely.
comments on that.
Yeah.
If you Google or you talk to a lot of people in finance, financial planners or money managers, and you ask the question, well, how much do I need when I retire? You're going to hear them say, oh, you need 70% of what you currently spend. Oh, then some say, oh, no, you need 75% of what you currently spend, because when you retire, you're going to slow down. You're not going to have as many expenses. Some will even say 80%. All that we know after all these years of working with physicians is that if Jeff or I walked to our clients and said, oh, by the way, I know you're retiring tomorrow, and we're going to drop your income 25%. We wouldn't be around long, because what we find out in reality is you work hard all your lives, and if you form good savings habits, you don't intend to take a cut when you retire. That is the norm, that a physician will expect their income to be the same or higher. So you may read 70% is all you need of your income, but in real life, you want 100% of your income. So that's the amount you should shoot as your goal, to have the same income when you retire or when you're working. Yeah, Jeff. Yeah,
the real way that we look at that number is to do what's called the cash flow worksheet, which we're going to talk about in a minute. And what that is just a list of all your expenses, but you would do one, a pro forma that looks at, well, when I'm retired, what do I want to do? Your travel budget's usually going to increase significantly. What expenses are going to be there and what expenses aren't going to be there. But 9 times out of 10, the expenses don't go down, they go up, particularly in the earlier years when you retire, because you want to travel and you want to get out there and do all the things that you've been waiting to do your whole life when you're retired. So it's not just a real benchmark of, oh, it's 80% of your income. No, it's real life, and it's customizable to what you want to retire on. And that is done by a thorough cash flow worksheet. It's extremely important to understand that your retirement numbers hinge on that number being right. Because if you predicated your whole retirement plan on a number that was too low, and you get there and your expenses are more than that, then you got a problem, right? And a lot of people don't spend enough time looking at, what do I really need to spend in retirement? What's my real number that I really want to bring in to live the lifestyle that I want to live and that I've worked so hard for? Okay, it's a big deal, but often overlooked. But it's worth the time to figure that one out for sure.
And Jeff used a great word, customize. You have to customize what you want. You're not the person sitting next to you. You're not the guy scrubbed in the OR over there. It's you. It's got to be customized. Don't let them just standardize you and say, well, you need 70%, 80%. You've got to customize it. That was excellent, Jeff. Thank you.
Yep. So this is just kind of a real rough run number here. So let's say I retire at 70 and we're planning to age 100, remember, for longevity. So I got 30 years to live and I want to live off, in this example, $100,000. How much would I need in my nest egg to produce that $100,000 a year, make it last for 30 years and keep up with inflation at a 6% return? It's about $2 million. And not a lot of physicians want to retire on $100,000. So let's say $200,000. You need about $4 million. All right, double the number. All right, so 300,000, $6 million. All right, so this is, well, once again, kind of just a rule of thumb here on how to get to that number. All right, so big numbers. All right, but you all should be able to get there. How do I save $1 million if I need an extra $1 million to hit my goal? And in 15 years, at 5%, I need to put away $3,700 a month, right? If I wanted $2 million, another $7,000 a month, which a lot of people can afford when you're in the red zone. Boom, you got an extra $2 million. The point of this exercise is to show, customize the plan and understand how much you need to put away on a monthly basis to hit that target number based on an income need that you've thoroughly analyzed through a cash flow document, and make sure that you run all the numbers to make sure that you're on track to hit that goal. I'm going to share with you a document here that kind of brings it all together. Mike, I'll go over the first page. You want to go over the second page?
Yes, why don't you do the numbers, and especially the two end columns, okay?
Yeah. So what this shows here is a couple retiring at age 67. Now they were younger, they were like 55, but their future value, inflation adjusted income need was at $396,000 a year. Okay, so a little under $400,000 a year they wanted to live off of. The next column.
Do you know what the present value is for that one?
I think it was like 250, and it grew to 400.
Okay.
The $48,000 is the Social Security kicking in at 67. Not a big Social Security number. So the difference is they have to make up that $348,000. Their nest egg, they have about $5.6 million. That's kicking off about 5%, which is about $265,000. That's not covering their full needs. So what happens is they start to dip into principal fairly early on, and they're out of money about 85, which is around their life expectancy. Okay, so this doesn't work. This is a plan that's not working. So what would they need to do in order to make this a reality and make their money last to age 100? Michael?
Well, if somebody says to me, Mike, I just saw Jeff go over my retirement numbers, and so what do I do? And how much do I have to save a month? And I'll say, well, it all depends. It depends on what rate of return that you're going to get. So if you look at this chart, what we're going to show, ignore the red one, that's a combination of things. But the higher your rate of return, the less you have to put away. If you want to see how important the rates of return are on your investments, look as we go through each one of these in the minor differences in rates of return and the reduction in the amount you have to put away. For example, if you make 4.74% on your investments for these people, all they had to do was put away $9,854 a month. That's all. That's tongue in cheek, I say that. If they get, instead of 4.74 to 5.13, it drops to 7,000. At 5.53, it drops to 4,500. If at 5.92, these are minuscule changes. At 5.92, it drops to 2,160 a month. If they get the rate of return up to 6.31%, they're fine. Okay. One of the keys that you're going to hear Jeff and myself say 100 times during our classes is the key to becoming financially independent is learning how to steal from yourself. And what's the best way to do that? Your retirement plans. Go ahead, Jeff.
So I just want to jump back to this page. This page is taking everything into consideration that we just talked about. Longevity risk. Well, I need to make sure my money lasts to age 100. Inflation, when you look at that first column where it says total need, that number is going up by an inflationary number. 3 or 4% is the number that we'd like to use. So we're addressing both the inflationary issue and the longevity issue here. This exercise needs to be done before you retire. If you're working with an advisor that's not doing this, they need to do this. This is something that we do as part, by you attending the class. These are numbers we can run for you, no problem, free of charge, to make sure that you're on the right track. If you're short of your goal, we can tell you how much you need to put away on a monthly basis and at what rate of return we need to achieve to get there, and make sure that number that return is an attainable number, not an unattainable number. All right. So very, very important document. We provided a copy of this in your folder for you to look at. If you got any questions, feel free to let us know. But this is an exercise that needs to get done, because this shows, when do I want to retire? How much do I want to retire on? Inflation adjusted, all that stuff. And this is how you bring it all together.
And most of the time, this is very solvable. If you get your assets in line and you systematically save. It's usually, especially with physicians, it's usually very doable. Okay.
All right. Oh, there he is. All right. I think we're now gonna switch gears. We're gonna have Jason Hamblin. Mike, if you want to give Jason an introduction, he's going to be jumping on here and sharing the screen with us. There he is.
Okay, there he is. That good-looking guy. Jason Hamlin is a CPA with the firm of Cohen and Grieve. They're here in Tampa. They're probably the #1 CPA firm with physicians. And we deal with a lot of different CPA firms, but they specialize in physicians. And so he'll be able to answer any of the questions you ask. He's very good. They've been around for a long time. And besides that, there are nice people in that firm. All right, Jason, the floor is yours. Thank you very much, Jason, for giving your time to us. We appreciate it.
I'm just going to throw up the pages that I'm going to do here. And hold on one second. Slideshow from current. Alrighty. So as Mike and Jeff said, my name is Jason Hamblin. Work with the firm of Cohen and Grieve. We're actually in the same 2 buildings that Mike and Jeff are in. And what we're talking about today is probably going to be at kind of the 10,000-foot view on taxes. But obviously, if you guys have any questions, just go ahead and ask. If I don't know the answer right offhand, I'll go ahead and get the answer for you. And if you guys come up with any questions later or want to kind of go over your situation just in general, we don't charge for initial consultations or conversations and whatnot. So feel free to give us a call. So tonight we'll go ahead and talk about taxes. And obviously taxes are a big deal these days with the potential legislation that has been proposed. That said, the proposed legislation has kind of been ever changing with, depending on the time we're talking about, and as various factors change over time. So what we're going to talk about today is kind of planning with current tax laws and keeping in mind what you're anticipating to happen. It's a really tough and challenging time because nobody really knows what exactly is going to happen and when exactly it's going to happen. So, we're going to go ahead and talk about it today, and we'll try and answer things as best we can. But again, keep in mind that this is an ever-changing world today with taxes. So obviously taxes present another roadblock to your retirement, and that's in the form of not using tax laws to your advantage. Some of those examples of the ways to do that are deferring into your 401k plan if you own your own practice, making higher elective employer contributions, traditional IRA contributions if you're eligible to do that and an employer plan is not available, HSAs, that sort of thing. Not the most exciting topic in the world. I know most people, while they may touch on them kind of tongue in cheek at a party, if that, nobody's bringing them up as the main topic, nobody's getting together, on Saturday to have a fantasy league for taxes. So, not a real exciting thing, but at the end of the day, a very important concept because they can help you to pay legally fewer taxes to the government while maintaining maximum dollars for yourself after taxes. And that's really the key when you look at your situation, is really to see how you can achieve the best after-tax result, as opposed to always concentrating on the dollars you're paying in taxes. So that's one important thing to keep in mind. Another thing to keep in mind is that taxes affect almost every aspect of personal finance. Any of the stuff that Mike and Jeff were just talking about with rates of return and the stuff that you're investing and whatnot, all of that is dependent upon whether we're talking about after-tax dollars, pre-tax dollars, et cetera. And that all comes into the tax concepts come into play depending on whether it is a pre-tax or after-tax situation. So just looking at taxes in general, they provide many social benefits. The roads we drive on, the infrastructure that we have, I guess, for lack of a better word, all the benefits that we enjoy, entitlements, whatever they happen to be. And again, I mean, I know people have different opinions on them, but bottom line is that's what our tax dollars provide for. So tax planning for everyone is a critical part of their financial planning. There are a number of strategies to help you keep more of what you earn and maximize that after-tax income. But it's important to remember, like we talked about, the stuff that we're talking about today in terms of today's tax laws likely are going to be different in the future. So what you've kind of got to do is develop an overall plan and a strategy, and then make sure you stay on top of it. It's kind of like Jeff was saying before, develop a plan, implement your plan, and then revisit your plan as you go along. And that's just as important in taxes as it is in retirement. And again, the two are interrelated, so it's very important to stay on top of both of them. You don't want to base your entire financial plan on current tax laws, but rather develop the strategy, a general strategy like we were talking about before, for minimizing your taxes and then also trying to be able to pivot when tax laws change. So a couple of additional healthcare taxes that came about with the Affordable Care Act. There were two of those, primarily two of those. They were for folks with income over $200,000 or $250,000 for married filing jointly. And what that amounted to was a 0.9%, and that was a 3.8% additional tax on certain things. And that's the Medicare contribution tax on net investment income. And then also a 0.9% hospital insurance tax on wages and self-employment tax. So the way they're both Medicare related, and the way you get back to the same number is if we take that Medicare contribution tax of that 3.8%, which is the net investment income tax, that's comparable to the hospital insurance tax when added to your Medicare withholding and the employer's Medicare withholding, which are 1.45% each. 2.9% plus the 0.9, you get back to the 3.8. So essentially, what the government was trying to do was try to go ahead and raise some additional Medicare dollars by charging that 3.8% on everything instead of either 2.9 or in some cases 0, depending on the income. So some tax terms as we're going forward. Gross income, as the name implies, it's going to be all of your income from all taxable sources before subtracting out any of your adjustments, deductions, exemptions, etc. Your adjustments are going to be special items, which were actually whittled down with the most recent tax act passed at the end of 2017. And now things like student loan interest, eligible IRA contributions, HSA contributions, etc., are those kind of deductions. They can lower your taxable income and ultimately allow certain taxpayers to qualify for certain other deductions, which are based on a percentage of your adjusted gross income. That's why that's such an important number. The AGI determines whether you're going to be eligible for certain credits, certain other deductions, the qualified business income deduction. It's all interrelated. Again, the adjusted gross income, as the name implies, is your gross income from all taxable sources minus those specified income expenses or deductions or adjustments that we were talking about. It's the amount from which the standard or itemized deductions and personal or, well, not any personal and dependent exemptions anymore, but from your standard and itemized deductions are deducted to determine your taxable income. So you take your gross income, less your special adjustments, less your itemized or standard deductions, and that's where you get to your taxable income. Again, the key to determining your eligibility for certain tax benefits and your phase out of the eligibility for others. So talking about our deductions, whether standard or itemized, we'll start with the standard deduction. The standard deduction is the amount that you can use to reduce your taxable income without doing anything else, you don't have to own a home, you don't have to pay real estate taxes, sales taxes, any of that stuff. It depends solely on your tax filing status. So whether you're single, married, filing jointly, head of household, etc. The annual adjustments for the standard deduction are based on the Consumer Price Index, and the 2021 standard deductions are listed there. Single is $12,550, and the married filing jointly doubles that, and then the head of household is right about in between the two numbers. So as an alternative to your standard deduction, you have the option of taking itemized deductions. And the itemized deductions are certain qualified expenses, which when added together, if they exceed your standard deduction, you can go ahead and take the itemized deduction. Those deductions are going to be your state and local income taxes, mortgage interest, medical expenses, charitable contributions. That's primarily limited to those amounts. Prior to 2017, there were unreimbursed employee business expenses and other things that you could go ahead and deduct. But then the 2017 Tax Act, the Tax Cuts and Jobs Act, eliminated those items. Additionally, a lot of folks these days have a harder time taking advantage of the itemized deductions because with the 2017 Tax Act, they eliminated the dependency exemption and essentially doubled the standard deduction, making it harder to get over that standard deduction with your itemized deductions. So just something to keep in mind, as you consider that for your tax situation. Taxable income, tax returns, again, it's your income after adjustments, deductions, and exemptions. That's going to be the amount on which your federal tax bill is going to be calculated, and ultimately from which tax credits, once you calculate that tax, your tax credits can then reduce that prior to taking into account any payments that you've made. And that's an important thing to consider. Tax credits are a much more valuable thing to have than deductions typically if given the choice. Credit's a dollar for dollar reduction, whereas a deduction reduces your taxable income and therefore benefits you at your marginal tax rate. So a $100 tax credit reduces your tax by $100, but a $100 deduction, assuming you're, for example, in the 33% marginal tax bracket, reduces your taxes by $33. So for 2021, these are the federal income tax tables. You can see there for married filing jointly, head of household, and single. And it's important to remember there, if you're looking at married filing jointly, for instance, and comparing it to single, that's where you run into what's known as the marriage penalty. And we'll compare the last tax bracket, for example, to see that. If you're single, you can have up to $523,601 of taxable income before you hit, or $600 of taxable income before you hit the 37% bracket. So you would figure intuitively, hey, we'll just multiply that by 2. Then we've got the entry level for the 37% bracket for married filing jointly. But you look there and see that, oh my gosh, it's only $628,000. So the married folks have just lost out on essentially about $400,000 of income in a lower tax bracket as a result. So again, something to consider. I know that's not the driving factor in whether people get married, but it is definitely a contributing factor these days. And it has been for a long time when people look at that when they're planning for their taxes. So the marginal rate we were looking at on the prior page is often a misunderstood number. What it amounts to is that share of each extra dollar that will go to the IRS. And ultimately, the important thing to remember is, for instance, if we go back to that table, if somebody married filing jointly is in the 32% bracket there, let's say they've got taxable income of $400,000, that entire $400,000 is not taxable at 32%. They're going to have about $19,900 taxable at 10%, from $19,900 to $81,000 taxable at 12%, and so on and so forth. So it's not necessarily, you're not getting taxed on at that marginal rate on all of those dollars, only the dollars that fall within that bracket. We've many times gotten people saying, hey, you know what, my employer wants to give me a raise, but should I take it because it's going to put me into a higher tax bracket? And what I usually say is absolutely you should take it, because again, you're still going to have more dollars at the end of the day after tax. And that's our goal, is again to maximize our after tax dollars in this case. Plus it's also additional money that potentially you can put into a pre-tax retirement plan and save that with Mike and Jeff, and they can go ahead and invest so that you actually have enough money to retire on. So again, this is a more simplified example at the bottom here with an income of $50,000. The first $9,900 for a single person is taxed at 10%, and so on until the last portion between 40 and 50 is taxed at 22%. Just something to keep in mind. So as far as tax strategies go, what you need to realize before you do any of that is make sure that any strategies you have fit in with your overall financial goals and objectives. What I always tell people when they ask about things is never do anything purely for the tax benefit. You always want to look at your economic goals first in that process. And that's why you want to look at your tax situation often 2 years at a time. That way you can look and see, okay, well, I might be able to get a tax deduction this year, but I might be able to get a bigger tax deduction next year, depending on where my income is going to fall or what bracket I'm going to be in next year. So some tax strategies to consider, and probably one of your biggest bang for the buck strategies is to participate in an employer-sponsored retirement plan. Most of those plans, your contributions are pre-tax and reduce your taxable income. The exception being is if you have a Roth side to that, or a mega backdoor Roth, that sort of thing, which can also be advantageous, again, depending on your overall financial planning goals. But a pre-tax employer-sponsored retirement plan does provide you long-term tax benefits because your principal and earnings grow tax deferred until withdrawn. And that's an important concept, tax deferred. People think, hey, you know what, I saved 37% this year. Well, yeah, you deferred 37%. But again, a lot of that's going to depend on, you're going to pay taxes when you withdraw that money later on. So you've got to consider, hey, what do I think taxes are going to be down the line? What are my ultimate goals and objectives? Am I, in a better spot if I hedge my bets and do some pre-tax and some post-tax at this point in time? And again, those are things where you meet with Jeff and Mike and talk with them and say, hey, these are my goals and objectives in retirement. How do I get there? If you don't have an employer-sponsored retirement plan, the next best option is to contribute to a traditional IRA. And those contributions, similar to an employer-sponsored plan on the pre-tax avenue, would be tax deductible, potentially, depending upon your income. If they're not tax deductible, you still might want to make those contributions because, again, at that point, you go ahead and make those contributions, and now you've got basis in that IRA. Your earnings will still be taxed, but you can then pull out some of that basis tax-free down the line. Another option is if you typically don't have, or if you don't have any other traditional IRA dollars, is you can put that money in a non-deductible traditional IRA, then immediately flip it over to a Roth IRA, at which point not only does the contribution become tax-free upon retirement or withdrawal at retirement, but so do the earnings. Again, this is one possible change that may be coming down the line with tax legislation. Excuse me. But currently, it's still something to consider and still potentially a good idea. Now, if you do have other traditional IRA monies, it's important to let your tax preparer know that, because what happens is when you go ahead to convert, a portion of, or a prorated portion of your traditional IRA monies will be taxable at that point if you've put them in on a pre-tax basis. So that's something to consider as well. It may not be a bad thing, for instance, if you're in a year similar to 2020, when people had a lot of down income, and at that point, a lot of people went ahead and converted traditional IRAs over to a Roth and went ahead and paid the taxes, albeit at a lower rate. So for 2021, you can contribute up to $6,000. Again, that's less than an employer-sponsored plan, but nonetheless still $6,000. Or if you're over 50, $7,000, or the lesser of that, or 100% of your earned income. A third strategy, and this is something you can do in conjunction with either an IRA or employer-sponsored retirement plan, is to contribute to your flexible spending and or health savings accounts. Health savings accounts are great because they allow you to go ahead then and pay for medical expenses pre-tax effectively, whereas your medical expenses as an itemized deduction are typically subject to a pretty high floor, and that's assuming you're even able to itemize your deductions. A lot of us have those HSAs now. You have to have an eligible health insurance plan to be able to have an HSA, but nonetheless, it's a commonplace thing nowadays. Contributing to a flexible spending account, those are going to be things like dependent care benefits and certain other items that you can spend that money on. The important thing to remember with that flexible spending account is it's typically a use it or lose it. So you want to plan for that at the beginning of the year when you decide to put that money away into that flexible spending account so you don't lose it at the end of the year. Again, while it shouldn't be your sole focus, you definitely want to consider your tax implications when timing certain events in your career, your retirement, et cetera. For example, when you retire, folks will often receive their largest paycheck upon retirement. They're going to get paid out. They might get maybe a severance or their vacation paid out or whatever. And if you're doing it toward the end of the year, it might make sense to say, okay, well, my last day is going to be effective instead of December 31, where it all gets paid out in December. I want to make it effective, say, January 5th, so that you have your usual year's income in the current year ending December, and then the next year, the only wages you have are that extra, that severance, that vacation, bonus, whatever it happens to be. And therefore you can take advantage of it at a lower tax rate. So something to consider there. When itemizing your tax deductions, again, you want to consider where you're going to benefit from the most, mortgage interest taxes, et cetera. There's not a lot of wiggle room with that. There used to be ways where you could double up on charitable contributions, excuse me, which you can still do. However, real estate taxes and other taxes, which people used to also double up on, have now been capped at a $10,000 maximum deduction each year, which, as most of you know who own a home, $10,000 in property taxes is not a hard mark to reach, especially when considered in conjunction with sales tax or state income tax, which we don't have in Florida, but other people often do in other states. Again, one more strategy is consolidating deductible expenses. These are going to be, again, fewer and further between, and it's kind of going to have to be a specific situation. But again, it might allow you to take advantage of the itemized deductions in one year, and then take the standard the next year, where you might not benefit from itemized either way if you didn't bunch them together. Non-essential dental and medical work, you might want to bunch that all together and perform it the same year. Again, assuming that your income is low enough or your deduction's high enough to benefit. Make your charitable contributions again in that same calendar year. Consider giving next year's contributions in this year along with it. That's doubling up on those. The other thing you might want to consider with respect to charitable contributions is considering a donor advised fund, whereby you do that through an investment advisor, and you make several years charitable contributions at one time into that fund, and then you have some input with that fund on when those contributions are doled out and to what charitable organizations. Consider donating appreciated long-term securities. There you can get a full fair market value deduction and not pay the capital gains tax on that appreciation. Conversely, if you're going to contribute securities that are depreciated, again, few and far between in today's markets, you may want to consider selling those securities first to take advantage of the tax loss, and then taking the deduction for the entire amount of cash to charity. You're still effectively getting the fair market value deduction, but also getting the tax loss that way. Taking advantage of adjustments in tax credits, again, they can make a big difference in your tax liability for the year. Student loan interest, eligible contributions to traditional deductible IRA. These are things that, if the situation works out, you may be able to benefit from. Tax credits for child and dependent care expenses, adoption expenses, foreign taxes paid, and educational expenses. Those are all things that you can get deductions for as well. Stuff like child and dependent care, however, when we were talking about the flexible spending before, if you're somebody that, say, excuse me, is in the 37% bracket, you're better off doing it through the flexible spending account, where you'll receive a 37% deduction versus, doing it as a deduction, or sorry, as a credit on your return, whereas you get 20% of the first $3,000 or $600. So it's 37% of $500 or $600. So it's clearly more to take it through the flexible spending account. Education credits, such as the American Opportunity Credit, can provide pretty valuable tax reductions. Again, assuming you qualify, you have to make sure that your income, or you don't have to make sure, your income has to be low enough for you to be able to be eligible for that. Lifetime learning credit, again, similar to the American Opportunity Credit, it provides a up to $2,000 credit versus the American Opportunity Credit, which is $2,500. But still, you have to meet the modified adjusted gross income hurdles or phase outs to qualify. Using the capital loss rules to your advantage, another important tax strategy. Capital losses can be used to offset your capital gains. Again, that's pretty intuitive as long as the securities are in a taxable account. So you can't take losses in your traditional IRA or your Roth IRA for that matter and use them to offset taxable accounts. If your capital losses exceed your capital gains in a tax year, you can use up to $3,000 of those losses to offset earned income, or otherwise known as taking a net $3,000 capital loss each year. Everything in excess of that $3,000, you can carry it forward to offset gains in future years, and ultimately, until it's exhausted or you have sufficient gains. Until you exhaust the $3,000 a year or have sufficient gains. So it's critical to time that properly. So in other words, if you're going to have a big gain in 2021, for example, and you say, well, geez, I have all these other losses, you might want to consider taking those losses if they're on investments that you're not expected to recover, and take those losses in 2021 against the gain. The worst thing to do would be to say, hey, I'm going to have this big gain in 2021, then have the loss in 2020, and then you're limited to a $3,000 loss where you could have taken all the loss or a good portion of that loss in 2021. Be mindful of wash sale rules. If you sell a security at a loss and buy back the same security within 30 days, that loss is not allowed for income tax purposes. That's a key thing to remember. So in order to get around that, sometimes if you sell something at a loss, but you don't want to be out of the market, you might consider a similar but different investment to replace that security. Buying and selling mutual funds is important to time that properly. Buying it after the annual distribution of capital gains and dividends lets you avoid being taxed on the distribution. Likewise, selling those before they pay a large dividend at the record date will also allow you to avoid paying tax on that at that point. Again, those selling might allow you to pay a lower capital gain rate instead of the ordinary income on any non-qualifying dividends. It's just something to keep in mind as you're doing that. Again, look at the economics of the transaction first, and then then say, hey, you know what, based on that, what's my tax impact going to be? And then compare to different scenarios. Again, something we kind of touched on before, positioning assets in different types of accounts. Sometimes, sometimes it's nice to have a mix of pre-tax and after-tax investment accounts. But you want to, in your taxable accounts, you want to position your more tax-efficient investments, such as your, maybe your growth stocks, where they might not pay anything dividend-wise, but they're going to go ahead and build value. Put those in your taxable accounts, and your less tax-efficient investments, the ones that are going to pay out ordinary income, dividends, et cetera, in tax-deferred accounts. Another thing to keep in mind is take advantage of all your deductions. Be sure not to lose anything that you're eligible for. Again, if that involves grouping deductions in a given year, go ahead and try and do that, and that's going to involve some planning ahead of time. And again, if you're in a year where you may have lower income, consider again doing things like converting a traditional IRA to a Roth IRA and doing so at a lower tax rate than you otherwise would in a year where you have higher income. And I know for most of you, if you're W-2 wages, you might say, well, hey, I'm pretty consistent each year. Well, you might have a year where, okay, for one reason or another, you're going to earn a big bonus this year, but you're not going to earn it next year. Well, okay, then you want to postpone and look at taking that additional income, say from a Roth IRA conversion, into the next year where you're not going to have that additional bonus income. With investments, it's important to consider the tax status and the type of earning. Again, it should be considered when you're developing your investment strategy first and then your tax strategy afterwards. And investments spin off income of different characters and whatnot, and we'll take a look at those. First, you have interest, which is your simplest kind of income. Again, that's typically paid on a savings account or certain certificates of deposit, bonds, that sort of thing. Usually taxed at ordinary rates, except in the case of tax-free municipal bonds, in which case it's not taxable. but ordinary rates is the key for most interest income. Next, we have dividend income, and that's typically a portion of a company's earnings, which gets distributed to its shareholders. And that's typically quoted in a dollar per share amount. And dividends can be separated kind of into two categories, ordinary and qualified. Ordinary are taxed, as the name implies, at ordinary rates or your marginal rate, whereas qualified dividends are taxed at long-term capital gains rates. Why is that important? Well, long-term capital gains rates are significantly lower today than our ordinary rates for most people who are earning dividend income. One thing to consider, though, is depending on what happens and depending on where your income is, those qualified dividends taxed at long-term capital gains rates may end up getting taxed as high as your ordinary rates, depending on your income and what tax legislation gets passed going forward. Again, try and stay abreast of developments in tax law. Stay up with your investment advisor, your CPA, et cetera, so that you're aware of this stuff and so that you can pivot appropriately when the time comes. Capital gains. Capital gain is an increase in value of a capital asset, an investment that gives it a higher value now than when you purchased it. It's not realized until the asset is sold, which point you have a realized gain, where those realized gains held for longer than 12 months are taxed at long-term rates, less than 12 months are short-term rates. And again, typically the long-term rates are more favorable these days. However, depending on the tax law changes, that could obviously change. So currently for long-term capital gains rates and qualified dividends, these are the tax rates that a taxpayer will be subject to, depending on whether they're single or married filing jointly, and depending upon their income bracket. So as you can see, for single people, if all you had was investment income, you could make up to $40,000 and not pay any tax on it. Similarly, a married filing jointly couple up to $80,000. If it's all long-term capital gains rates, they would pay no tax on it. Then there's a 15% bracket on that, and then a 20% bracket. It's also important to remember that there's also that Medicare tax we talked about, that contribution tax of 3.8%. So your long-term rates can vary really from 15 to 18.8% for the 15% rate, or 20 to 23.8%. So that's something to remember there. Likewise, those short-term capital rates are also subject to that. But it's important to remember when you're selling something nowadays under current tax law, not just to assume, hey, it's going to be 20%, it could be as high as 23.8% or 24% in this case. So something to consider when you're planning. Investment tax rates. Again, qualified interest, royalties, passive income, all of that stuff is subject to that net investment income tax that we just talked about. That's at 3.8%. And that kicks in at a modified adjusted gross income, essentially. So just essentially think of your adjusted gross income when it exceeds the amounts listed there for those various filing statuses. So it's $250 for married filing jointly, half that for separately, singles $200, and qualifying widow with child is $250. Again, we see the marriage penalty come into play when a single or head of household is $200,000 and married is $250,000. So something to consider there as well. A big one these days, especially with our ever increasing property values, is a tax exclusion for home sales gains. And that allows us to, if you're single, to exclude up to $250,000 of gain. If you're married filing jointly, up to $500,000 of gain on a property. When this law was originally passed, it was kind of few and far between where people had these kind of gains. And now this is one thing where taxpayers can definitely take advantage of that. Again, this is a tax concept, and you always want to think in terms of economics. The biggest thing people say now is, yeah, I could sell my house for, 3 times what I paid for it, but guess what? You got to buy a new house. So unless you're getting transferred for your job to Eastern Idaho Medical Center, where the property values are 1/10 what they are here, good luck economically, finding another place. But assuming you can, and assume those and exclude those gains, you have to meet 2 different tests. There's an ownership test and a use test. And the ownership test is during the 5-year period ending on the date of sale, you must have owned the home for at least 2 years. The use test during that same 5-year period, you must have used the property as your primary residence for at least 2 years. One key to remember there, or to consider, is that if you have a married filing jointly couple, and let's say that only one of them is listed as the owner of the house, only one of you has to satisfy the ownership test, but both of you have to satisfy the use test to get the full exclusion of gain. Again, the previous, one other thing is consider the previous sales test. During that 2-year period ending on the date of sale, you can't have another exclusion of gain from the sale of another home. And again, the rules we just mentioned there, one spouse has to pass the ownership test, but both spouses have to pass the use test. If you don't meet all of those qualifications, and under certain circumstances, there's a prorated exclusion of gain, which may be available, but generally speaking, you want to try and meet both of those tests to exclude that gain. So that concludes my portion. Sorry, I went through that very quickly, but if anybody has any questions, I'm happy to take those now. And if not, if you come up with any questions, you're welcome to call me, text me, email me, send up a smoke sale, send me a telegraph, whatever you want to do. Or not.
Jason.
Yes, sir.
If they make tax law changes this year, let's say they make them in September or October, 10 months into the year, is that going to be effective from that point on, or are they going to back it up to January 1st of this year and tax you from there?
That's an excellent question. Although they have retroactively done things before, typically they'll establish a line of demarcation and say from this date forward. That's not to say that it's going to happen, that either one of those are even going to happen. They could say, okay, starting in January 1, it all depends. So basically the answer is it depends. They could do any one of a number of things as far as dates. I would highly doubt that they would do it back to January 1, but that's not to say that they can't. A more likely thing is for them to pick a date or that line in the sand and go forward from there.
Thank you.
Yep.
All right, I think we're going on to the estate planning section. This is the last chapter of the book, but we've got a guest speaker tonight, so we're gonna kind of do that one. They're all these chapters are mutually exclusive of each other, so we're gonna go ahead and do the estate planning section. Mike, if you'd like to do the introduction, and Melissa, I think you need to share your screen if you're gonna put up a presentation.
Oh.
Okay, well, first let me introduce you, Melissa. There she is. This is Melissa Rodriguez. She's with the Ackerman Law Group. The Ackerman Law Group, probably with 2 other law firms, are the best healthcare firms in the area. They're excellent. They deal with a lot of physicians. They deal with all aspects of the legal side with physicians. They're a great source of knowledge. And if any of our physicians have questions, they will help you. And so it's my pleasure to introduce Melissa Rodriguez, attorney at law.
Thanks, Mike. Thanks, Jeff. As Mike mentioned, we are a full service law firm. So we handle all sorts of matters. My focus is primarily on wealth preservation. So this includes estate and asset protection planning. I draft a lot of prenuptial agreements. I do dissolutions of marriage. I administer probate and guardianships, and I engage in related litigation. A lot of it guardianship litigation, probate litigation. So my focus is on preserving your assets. I'll see if I can share my screen. We also have attorneys who are contract attorneys. We have an entire healthcare department as well. All right, are you able to see my screen?
Yes.
Okay, great. So I wanted to start the discussion with very basic estate planning. And estate planning is just basically making a plan to protect yourself and protect your family members, your loved ones, in the event of your incapacity, and to plan for your death. We plan for incapacity and death using a series of documents. For incapacity, you'll see, there may come a time where you are not able to make your own medical decisions, and you're not able to make your own financial decisions. So we have you sign these documents beforehand to nominate individuals who will do this for you. You may be familiar with the healthcare surrogate designation and with a living will, and with what's called a designation, pre-need designation of a guardian. Those are all healthcare related documents, and it names somebody to make healthcare decisions and to receive private health information when you're not able to make those decisions. I wanted to highlight the durable power of attorney, though, because you may be more familiar with the healthcare documents. Under the durable power of attorney, you appoint an agent to make financial decisions for you. This agent will have the power to do simple things such as make deposits and withdrawals in bank accounts. But they can also engage in more involved matters, such as changing your entire estate plan, disclaiming assets for you, changing your beneficiary designations. So it's really important that you keep this in mind when signing these documents. The durable power of attorney becomes effective immediately upon your signing. So it's a very, very useful document, but it's also very powerful. So it should only be given to somebody that you trust implicitly. I've had clients refuse to sign durable powers of attorney, even when their spouse is the agent. And I've had a number of other clients sign the durable power of attorney, but keep it private until it's necessary. This series of documents is really only in effect during your lifetime. After your death, your durable power of attorney ceases to be effective, and then obviously your designation of healthcare surrogate and your living will also cease to be effective. Planning for your death. So to plan for your death, the first thing I always recommend doing is taking a look at your assets and seeing how everything is titled. Beneficiary designations can be added to assets like bank accounts, retirement accounts, insurance policies, savings bonds, and a range of other assets. These assets that have beneficiary designations avoid the probate process. And I'll explain probate a little bit in more detail in a few minutes, but this is a very useful tool to avoid probate of those assets. The same is true with joint ownership of accounts and of any other assets. You've got to remember this is very useful to have joint ownership of accounts, and usually people do this. They'll name their child or they'll name another family member. But what people often don't think about is that that other person who has joint ownership of your assets has the right to give away the assets, transfer it to another account, spend it, or do any of those things without your consent. The other issue is that sometimes these individuals are in the process of a divorce or a lawsuit or bankruptcy, and now your account becomes part of those proceedings for them. So this is a great tool to avoid probate, but there are other better ways to handle avoidance of probate for those assets. The beneficiary designations and the jointly owned accounts pass outside of your probate estate. Everything else passes typically under your will. The will detail how you want your assets administered and distributed after your death. You would be referred to as the testator, and the testator is the person creating a will. The testator appoints what's called a personal representative. And the personal representative is in charge of administering your estate. So this person is the one who complies with state laws to probate your will. They present the will to the court, and they pay your creditors, they pay your taxes, and then they distribute the remaining assets among your beneficiaries. A will is also commonly used to appoint a guardian for your minor children. So you would say today, if upon my death, any of my children are minors, I appoint X individual to serve as guardian for your minor children. And this can be modified at any point as long as you are not incapacitated. One thing I did want to note is that the will does not avoid probate. Probate is a court supervised process to transfer the ownership of your assets to the name of your beneficiaries. Part of this process ensures that creditors are paid, they're notified of your death, and that they're paid. This includes the Agency for Healthcare Administration, your credit cards, FPL. Your personal representative would go through your mail and determine who are creditors or who could potentially be creditors and notify them. Then there's a 90-day period for them to file the claims. And all of these creditors must be paid along with your taxes before the remainder of your assets are distributed to your beneficiaries. If you die without a will, the personal representative goes through this exact same process. The only difference is that your assets are distributed among your heirs, or what Florida law considers you would have wanted as your beneficiaries. This is typically your spouse, and there are rules, there are percentage rules, depending on whether you have children from previous relationships or marriages, or whether all of your children are from the same relationship. So Florida has a formula for who it thinks that should be your beneficiaries if you do die without your will. The other thing I wanted to mention is that if you die without a will, the cost of administering the estate is usually significantly higher than if you died with a will. This is because we've got to prepare affidavits of heirs, sorry, not beneficiaries, affidavit of heirs, with a lot of backup information that takes a lot of work to present to the court. One way to avoid the probate process is with a revocable trust. So a revocable trust is essentially an agreement to create and hold ownership of your assets. So under the revocable trust, you would be considered the grantor. And in most cases, at least at the beginning, while you have capacity, you would serve as trustee. So essentially nothing changes. The only thing that changes in the control and ownership of your assets is the title. The trust also has the function of directing the distributions of your assets upon your death. Let's see. I'll go back. It has some additional benefits. So if you become incapacitated and you have assets inside of your trust, your successor trustee becomes in charge of managing those assets for your benefit. Your trust can say how you would be considered to be incapacitated. You would say, only if my primary physician determines that I'm incapacitated, then the successor trustee takes over and manages the assets for my benefit. Or you can appoint a committee of 3 physicians, and by a majority, they would have to determine your incapacity. This is highly beneficial, but it's really important that the trust be funded. The trust also maintains privacy. So a will becomes a matter of public record when it's submitted for probate. So anyone could stop by a courthouse and read your will. They will know what you owned and whom you left it to. Generally, with a trust, no one other than the beneficiaries are entitled to see the trust document. The trust will not become public record unless there's an heir or beneficiary who challenges the validity of the trust. And at that point, you've got a litigation and you've got documents subject to public inspection. So this is the comparison. Generally, the costs for establishing a revocable trust are a little bit higher upfront, but if you avoid the probate costs altogether, you could end up or your estate would end up saving a lot of money in the long run. I did want to provide a few words of caution on the revocable trust. I've seen a lot of revocable trusts that do not address mental incapacity. So you've got to make sure that your revocable trust has all of these provisions so that your successor trustee can take care of you if you've become incapacitated. There also seems to be a common misconception that if you transfer your assets to a revocable trust, then your assets are protected from the claims of creditors. They're not. Revocable trusts offer no creditor protection for you. It could offer some creditor protection for your beneficiaries if it has the correct language. And I'll talk about that more in a little bit. So I'm going to move from the basic asset protection, the basic estate planning documents, sorry, to some asset protection. I've put together a list of things that are threats to your wealth. And I think for you in particular, you've got malpractice suits that are a significant threat. We've got tax liabilities, divorce. And I know that the previous section discussed tax liabilities, but I wanted to mention the current estate tax system. So currently you can each pass up to $11.7 million to your beneficiaries, to your children, friends, whomever you desire, without incurring estate or gift tax. This $11.7 million is referred to as the estate and gift tax exemption, and that is current law. It is set to change from the $11.7 million that we currently have to $5 million per person, indexed for inflation, at the end of 2025. That's current law. The estate tax is anything over 40%, is anything over the exemption times 40%. So you're looking at a tax of almost half for everything over that set exemption amount. There is proposed legislation to accelerate the reversion of the exemption amount and lower it from the 11.7 million to the 5 million index for inflation at the end of this year instead of at the end of 2025. This would be effective January 1st, 2022. So if passed and we revert to those lower amounts and your estate your net worth, is greater than $5 million, you could be losing out on the benefit of transferring approximately $5.68 million without estate tax. I highly, highly recommend that if your net worth is anywhere in that range, that you consult with an estate planning attorney before the end of the year. And I also want you to know that when you're calculating your net worth for federal estate tax purposes, the death benefit on your life insurance policies is included. So if you've got a whole life insurance policy with a death benefit of $2 million, that's almost half of the proposed estate tax exemption amount. I have a summary here. Another huge issue is divorce. I'm not sure if the pandemic has anything to do with it. I think it does, and I think people put weddings off for a while, but I'm seeing a huge, huge number of prenuptial agreements and dissolutions of marriage. I highly, highly recommend, especially to physicians, to consider prenuptial agreements before marriage.
Amen. That's right.
This is especially true if you do not want to run the risk of having your ex-spouse co-run your medical practice. You do not want to be in a position where you are already in the middle of a divorce and you're having to pay a lot of money to value your medical practice and try to make an offer to your ex-spouse to buy them out of something that you built. I highly, highly recommend, if only to address your business, I highly recommend prenuptial agreements. It's much, much easier. It's always an uncomfortable situation. It's always an uncomfortable discussion with your spouse. But it's much easier to agree on those uncomfortable subjects when you're getting along and you're contemplating marriage than during a bitter divorce. It's also possible, if you're already married, to enter into postnuptial agreements. I've done these when couples realize that there are issues that they've never addressed before, or suddenly there's a big difference in assets from the time that they got married. Or oftentimes when a marriage is kind of rocky and there's a spouse that has significantly greater income and more assets, and that spouse needs to determine whether they're going to stay in the marriage or whether, while they're accumulating assets, or whether they're going to consider divorce. The longer that you're married, the higher the risk and the higher the degree of permanent alimony and of sharing income that you were earning during the marriage. So that's another reason to consider postnuptial agreements. So exempt assets. Florida, the state of Florida has done some asset protection for you. And I encourage everyone to take advantage of these exemptions because it does protect your assets from creditors. Now, a lot of these things don't apply in the family law arena. So a family judge doesn't care about your homestead, doesn't care about any of these other things I'm going to talk about. This is more for third-party creditors, not your spouse. When you're trying to protect from spouses, if it's your spouse, prenuptial agreement, postnuptial agreement. If it's the spouse of your children or your beneficiaries, then trusts. So back to the exempt assets. You can waive these, but you should not. I've seen documents, mortgage documents, bank documents, where they provide waivers for these assets, where people waive homestead exemptions, they'll waive wage exemptions. So be very careful if you're signing anything where you see the word waive. Homestead exemption. The state of Florida has the best homestead exemption in the country. Not only can a creditor not seize your homestead, but at the last minute, while you're being sued, you can take an asset that is not exempt from creditors. You can take a regular bank account, cash in a bank account, or any sort of other asset and convert it to homestead, and the creditor will still not be able to take that asset. You'll see that there are specific rules there for homestead. And I'm moving a little bit quickly because there's a lot to cover here. Tenancy by the entireties. This one's really important for, I like this one a lot for physicians, but I will caution if you've got to have a good marriage for this one to be beneficial for you. This enables a married couple to own assets jointly, and it'll prevent a creditor who has a judgment against only one of the two spouses from taking the tenants by the entirety assets, or the TBE asset. So say you've got a judgment, malpractice judgment, and it's only against you. Your spouse is not liable for that. It would be possible for you to file for bankruptcy and have the judgment completely eliminated while keeping all your tenants by the entirety's assets safe. I also recommend combining the TBE and the homestead exemptions. It's like 2 layers of protection for your home from creditors. And I wanted to mention there are often times where couples assume that they have tenants by the entirety protection on an account or on any other asset, when that's often not the case. I've seen a lot of bank accounts where people assume that because there's joint ownership, you have tenants by the entirety protection. So please read the account opening, the account agreements, forms carefully. There should always be a box, and there are different boxes for joint tenants with right of survivorship versus tenants by the entireties. It is essentially the same thing, except that with tenants by the entireties, you have creditor protection. I also wanted to mention that there are other assets that you can own as tenants by the entireties. So you could have interest in a limited liability company and own that as tenants by the entirety. So you could add creditor protection to that. And then there are other assets out of states and in states where you don't have this law, you don't have tenancies by the entireties. So say that you have real property in a state that doesn't recognize this type of property ownership. You can create a Florida LLC, own the LLC as TBE, and have out-of-state property in there and add creditor protection to that asset. Florida law also protects your wages. This includes your salaries, commissions, and bonuses. It doesn't include dividends, so anything you pay yourself from your entities is not included. It's got to be earnings that are subject to employment tax. You'll see there I have outlined the statute and the specific rules. You've got to be the head of the household, so you've got to provide more than half of the income for child or any other dependent. Let's see. Okay, so you can protect wages by having a completely separate account for your wages to be deposited. I like the TBE protection better, and you're probably better off if you've got a good marriage by depositing all of your wages into a TBE account. This is because this exemption is valid for 6 months after the earnings are received. So if it's deposited in attendance by the entirety account, you're better protected. The other part of this is that if you've got excess wages that you have not spent in one of these accounts, you could always convert it into another protected asset. So you could use it to pay down your mortgage on your homestead. You could use it to invest in an annuity, in a life insurance policy, or just have a separate tenants by the entireties account where you, at the expiration of the 6 months, you could just transfer those funds to that account. Florida statutes also protects disability payments from creditors. This also applies if you receive a very large lump sum settlement from a claim. You've also got unlimited creditor protection on the cash value of your life insurance and your annuity in Florida. I wanted to mention the importance of the beneficiary designations on your life insurance policies and on your annuity contracts. After your death, when your life insurance proceeds are paid out, for most of you, these will be very large death payouts. I highly recommend that your beneficiary designation is that of a trust. This is so that the trust provides creditor protection, management of the assets, it provides protection from divorcing spouses, and estate tax protection for your beneficiaries. If you have your life insurance policy and you name your beneficiary outright, upon your death, your beneficiary, say it's your 30-year-old child or 35-year-old child, receives the $2 million in cash. And if at your death, it just so happens that your beneficiary is in the middle of a divorce without a prenup, the payout from your life insurance policy could become subject to the divorce. So I always recommend having a trust as a beneficiary. You can provide creditor protection, you could provide management, you could even provide estate tax planning for your beneficiary. Retirement accounts, again, are also protected from creditors in Florida. If your beneficiary is out of state without these protections, again, a trust can help them qualify for these creditor protections from the payouts. 529 plans and prepaid tuition. These are highly recommended if you've got for physicians with children, grandchildren, or even nieces and nephews. These are, you could even own these under your name. You can, if you are completely free to take the assets out and spend it on yourself, you still have creditor protection. And there are so many tax benefits in using these. I have one, I set up one for my young niece and nephew as soon as they were born, and this is what we do for their birthdays. These are highly beneficial. Personal assets, these are very minimal in Florida, especially if you're taking advantage of your homestead exemption in bankruptcy. But you can own your personal assets as TBE in a trust. Charging orders. This one's really important because I'm assuming a lot of you will own interest in partnerships or limited liability companies. And in most states, a creditor cannot take your interest in the limited liability company. Instead, what they take is a charging order. And the charging order, what it does is that it forces the partnership or the limited liability company to make the distributions that you would be entitled to your creditor instead of to you. This is fine because courts typically do not have the authority to force the entity to make distributions to you. So if you've got a creditor with a charging order and the LLC is not required to make any distributions to you, they will sit there with that judgment and your assets will sit without being distributed in the limited liability company. For this to work, you've got to have a multi-member LLC. So you've got to have at least another member who does not owe money or does not have a judgment from that same creditor. And it's super important that your operating agreement and all of your other documents are properly drafted. I've seen many LLCs or clients with LLCs who do not have an operating agreement, or worse, they're poorly drafted and don't take advantage of all of these provisions under Florida law. All right, so that was the asset protection that Florida law provides. I wanted to talk about asset protection planning with trusts. So the rule in Florida, we talked about revocable trusts. With a revocable trust, you're the grantor and the trustee, and you remain the beneficiary. That trust, as I mentioned, does not provide any creditor protection. So you cannot create a trust for your own benefit and have creditor protection. What you can do in Florida is create an irrevocable trust for the benefit of another beneficiary, have certain provisions in there, and that beneficiary will have creditor protection. Now, you will lose the ability to access the assets that you would put in that trust. However, there are some states, including Alaska, South Dakota, more recently Connecticut, Nevada, that allow you to create an irrevocable trust. That allow you to create an irrevocable trust where you are the settlor or the grantor, you transfer the assets to the trust, and you remain a beneficiary of the trust, and you have creditor protection. You do not have to have a connection to the state to take advantage of their favorable asset protection laws. What you do have to have is a local trustee. So we would set up the trust in a jurisdiction such as I often use South Dakota, with a South Dakota trustee and a trust protector. The trust protector can be anywhere, and the trust protector directs that South Dakota trustee on how to manage the trust, how to distribute assets, how to invest. So it's very, very flexible. There are also foreign asset protection trusts in many jurisdictions, such as Nevis. These usually offer more protection only because they are not, they could not be compelled by a U.S. trust to hand over assets in a bankruptcy proceeding or from a creditor. So you would have, your creditor would have to go to the foreign jurisdiction and obtain an independent judgment in that foreign jurisdiction. Lastly, which is not in here, I wanted to mention inheritance. Sometimes it's more important to have your parents' estate plan properly drafted. It's more important to work on theirs rather than yours. If you're expecting to receive an inheritance from your parents, you want to make sure that it's in trust, and you want to make sure that it's in trust to take advantage of estate tax exemptions. If you inherit your parents' assets outright, then those are assets in your individual name that are subject to your estate tax. They are subject to your creditors. They are subject to your divorcing spouse. They are subject to your any malpractice claim. So you want to make sure that if you are inheriting assets from your parents, that those assets are passing to you in trust. Sometimes clients come to me and the focus shifts from their estate planning to me providing a recommendation for their parents, or to me meeting with their parents because mom and dad have most of the money. So here's a quick list of takeaways. I think I'm over my time. But if anybody has any questions, I'd be more than happy to answer them.
If anybody has any questions, they can use the chat feature and send questions through the chat.
And remember how important questions are.
Mike,
If any of our doctors have questions, can they reach you later?
Yes, of course.
Okay.
Let me share my screen again to share my contact information.
Okay, thank you.
I think you may be able to see it.
Mike, your camera's off. I don't know if you know that.
All right.
Perfect. All right. Thanks, Melissa. If anyone needs to reach out to her, we can get you contact us or contact Melissa directly. But thanks for your help.
Thank you both.
Have a great night.
Thanks, you too.
Thank you very much. We appreciate it.
Thanks, Mike. Good seeing you.
Okay, bye-bye.
Bye.
Go ahead, Jeff.
All right. We're just going to go about 20 more minutes left here, and then we'll wrap up. We're going to jump back to section 3 out of the book. Remember, we don't follow every slide, so we jump from one to, we kind of minimize it for time purposes. So we are going to go back to section 3 here. Mike, your camera's off.
All right, thank you. I know.
All right. Should be in the lower left. Your camera should be on that way. You should be able to turn it back on there. Or up top.
All right. Go ahead. Go without me.
Okay. All right. So what we're going to talk about is just some common mistakes that we see people make when approaching retirement. And this is just a list of things that you don't want to do. Number one is don't define how you want to live your retirement years. This goes back to lifestyle planning. Just to recap, the first step in developing a retirement plan is, well, what do I want to do in retirement? That's going to be my lifestyle planning. A great exercise to go through in chapter 1. And why lifestyle planning is so important is because that's going to create a lot of your financial goals in retirement. You know, if I'm going to travel around the world, or I'm going to buy an RV and travel around the world, or I'm going to play golf, all those things cost money. So they're going to be, that's all going to play a role in the development of your actual income need at retirement.
Is that important?
Number 3, make a commitment to be financially successful. Anyone who's come to this class tonight is definitely taking a step in the right direction of commitment and educating yourself. As you approach retirement, you're going to be faced with a lot of important decisions. So it's crucial that you don't make any bad choices. We're going to talk about taking a financial inventory here in a minute, which is cash flow and net worth statements, 2 important documents. But let's talk about seeking professional assistance. You really want to build a team when you're approaching retirement, and that team is going to have a CFP, a certified financial planner, an estate attorney, and a CPA, right? When you're looking at financial professionals, the CFP designation is very important. That's kind of a step above, and it shows that individual has taken the time and studied and passed the exam, which is it's a very rigorous exam. So very important piece of information there. Investing early in life or on a regular basis. This is just that if you know you need to save, you know, let's call it an extra $12,000 a year, you do set it up systematically and pay yourself first. For systematic savings is the way that money gets into these accounts, right? Don't wait till the end of the year to make that contribution to stay on track to hit your financial goals. Have it done automatically, automatic bank draft. That way it comes out of the account and you never realize that it's gone. And I'm sure most of you are already used to doing that in the forms of saving for your 401ks, automatically payroll deduction and things like that. So number 5, we talked about tax laws already. Jason gave us a lot of great tax tips there. Number 6, you want to talk about asset allocation, Michael?
Yes, asset allocation. When we have a portfolio, when we look at a portfolio, an investment portfolio with a person, over 91.3% of the return in an asset portfolio doesn't come from when you bought a stock or a bond. It doesn't come from when you sold a stock or a bond. It comes from asset allocation. Because, people with investments, we can talk a good game, okay? But basically, we really don't know what asset category is going to do better this year or next year. So asset allocation, because you will be spread out, is the best way for you to plan your investments. Asset allocation equals 91% of the overall return in an investment portfolio. So what you just said, Jeff, is exactly right.
Yeah, and so once you develop what asset allocation is right for you, which is based on your time horizon, how much risk you're willing to take in the market. So maybe that might be 70% in stocks and 30% in fixed income. Every year you need to rebalance that portfolio, because what will happen, particularly in the last few years, you've seen stocks go up considerably. And that means that your portfolio may be out of whack. You might be at 80% or 90% stock, and that's much too aggressive for your original portfolio that you set up. So you want to rebalance. That's very important. Most of your 401ks or 403bs will do it automatically for you. But if you're working with an advisor, that's something you want to do in your annual reviews. Get back together, rebalance the portfolio, and get that portfolio back tuned up right in the right risk profile that you originally agreed upon.
And what Jeff just said was dramatically emphasized in the past 12 months. If you look at the gains that happened during that time, people that thought that they were in a moderate spread of risk, at a moderate risk, assets and the equity portion went so high this year that all of a sudden they're going from a moderate risk in their portfolio to a high risk. So when Jeff says that you need to reallocate each year, or rebalance, I should say, he's right on target again, especially this year.
Yeah, particularly the last couple of years.
Yeah.
Number 7. Number 7 is planning for the unexpected. Actually, we got a question in the chat. Can you address private placement investments? Could you address private placement investments in asset allocation? Private placements certainly have a place in the overall asset mix. Usually you have to be an accredited investor to be in private placements. They certainly can play a role. You don't want to be heavily weighted in any one particular private placement or in any one investment by nature. But they certainly can play a role. You just want to do an overall portfolio aggregation and make sure that you don't have a lot of overlap and that the risk fundamentals are still in line with what you're trying to accomplish. But yeah, private placements, particularly, we see a lot of more private placements in higher net worth individuals. The first starting is you start to build a foundation of an asset mix. And then after that, you start to add in private placements and master limited partnerships and things like that in certain circumstances. But once again, they usually tend to be a little bit more risky, and usually for accredited investors who kind of know what they've been doing and have been in the game for a little bit. Hopefully that answered your question.
Okay, number 8. Do you want me to take that, Jeff?
Sure, absolutely.
Okay, yeah. Number 8, physicians accumulate most of their wealth by far in their qualified retirement plans. And then also, depending on your specialty, they can accumulate wealth as part of their practices. But the thing that they start first, and the thing that really anchors and usually almost always becomes the highest percentage of a physician's assets, are the money that they have in their asset protected, tax deferred, qualified retirement plans. If you remember one thing from tonight and from the different experts that you heard speak, it is important to fully fund your retirement plans from day one to the day that you leave. And if you're in a practice, and this happens a lot, okay? If you're in a practice that you had for 20, 30 years, and then you leave that practice and you may end up working at a hospital or somewhere else, you would be amazed they will still let you fund, many of them, the retirement plan at the new place you went to after you closed your own practice. And I see that happen a lot. So funding the retirement plans from day one, whether you're just walking out the door as a resident to the day that you retire, you should fund those plans because they're asset protected. And a point that the attorney didn't bring up, but I know she meant to, is the most active time for physicians being sued are the last 7 years while they're in practice and the first 7 years that they're retired, because there's a 7-year period on that. Fund your retirement plans to the last day they're asset protected. Good, Jeff.
Number 9, we just covered estate planning. I don't think we need to comment much on that. And then number 10, as you can see, creating a financial plan is paramount. And that's what this whole class is about, and how to do that. So obviously that's very important.
Where we started.
That's how you start. That's how you start, right? Okay, so we're going to end this with 2 takeaways here. So we've determined the first step is determining what type of lifestyle we want to live. What age do we want to retire? Well, how much income are we going to need? And what do we have for assets that we're going to use for retirement? These are the next 2 very important documents. Mike, you'd like to talk about net worth statement?
Yes. With CFPs and CPAs, the 2 most basic documents we have are the net worth statement and the cash flow statement. And Jeff, I'll do the first, you want to do the second, okay? Sure. A net worth statement is a list of all of your assets, okay? You take a sheet, you list everything you have, all your assets, and then you list all the liabilities that you have. So you have all your assets, then you have all your liabilities, you minus out the liabilities, and what's left over is called your net worth. And that is one of the 2 most important and basic of all financial statements. The second is the cash flow statement. Jeff, you want to comment on that?
Sure. Yeah. So cash flow, we talked about that earlier. We recommend doing really 2 versions of the cash flow statement. One, cash flow now to make sure that I've got money coming in, I've got money coming out. Is it being dispersed in the most efficient ways? Am I taking advantage of all my retirement accounts that I should be funding? And do I have a positive cash flow? And if I do, am I deploying that positive cash flow in the best way possible? So that's step 1, understanding where my expenses are coming from now. The second one is for retirement. You look through the lens of retirement and do another cash flow saying, okay, I'm retired now. What's going to change? Well, a big change is probably going to be your travel budget, right? In most cases, people want to travel.
Good point.
Your discretionary spending, your fund money, that's going to be a significant increase, okay? So once again, when we talked about how important it is to understand the number that you're going to use to predicate your retirement plan on, this is really how you customize it and get in your head and figure out what that number is going to be, all right? You really need to understand that number. I can't express that enough. If you come in too low and you based your whole plan on a low number and you get to retirement and you're spending more money and your assets can't sustain that withdrawal rate, then we've got a serious issue there. So you need just to take the time and plan of how much money am I really going to need at retirement, do a thorough cash flow statement. And when you do that, it's going to break it down into 2 categories. You're going to have your variable expenses and your fixed expenses. I want to know what my fixed expenses are. That's paying all my necessary bills. I also want to know what my fund money or my variable expenses are. I can control that number if I need to, if the market's down or whatever the case may be. All right. But understanding my fixed and variable expenses is very crucial, and understanding where my money is being spent now, and also how much am I going to need in retirement We can email you a great cash flow statement that we created. If anyone wants it, to shoot us an email, and we'll
I
email.
highly recommend that you request that. I highly
Absolutely.
recommend it.
Yeah, you can do that, and we have it in Excel, so you can save it a couple different versions. And that's really the next step. All right. I know what I want to do in retirement. I know when I want to retire. I'm going to do my net worth statement, which is what do I have now for assets that are going to be used to produce income in retirement? And then also my cash flow, which is how much money do I actually need in retirement? All right. Those are kind of the first 3 steps in developing the financial plan to help you hit retirement, hit the ground running, and, make sure you plan correctly.
And Jeff said earlier to make sure that that number that you want for retirement is realistic, and make sure that it isn't too low. And wherever you are, the people that are here with us this evening, whatever, years you are, how many years you have left in your practice. Now, if you do a profile or a report or a financial plan, however you want to entitle it, you find out what you really need. You still have time to accumulate those assets and save more money to hit that goal.
Absolutely.
So when Jeff says that, he is right on target.
Absolutely. So we're going to wrap up now. Next week, we've got a great week. Very exciting chapters, actually. We've got the investment chapter. We've got Social Security. We're going to cover IRAs, Roth, backdoor Roth, traditional IRAs. We're going to cover all the asset protection and risk management piece as well. So we got a full 2 hours next week, same time, same place. And Mike, you got anything else to add before we wrap up?
One last statement. Please, with any questions, just get the questions to us. Get them to Elka. We'll answer them. We realize there's a lot of things you don't want to ask right now. Just sit back, think about it, and ask any questions that you have. And thank you all for attending. I hope it's been beneficial. Next week's actually a little bit better. We think because it's more of the finance and investments, but it's all good. Everything you're covering is extremely important. And so once again, thank all of you. And good night.
And I just want to make a quick comment. Mike and Jeff, thank you both for a very informative webinar once again. And I hope those that joined tonight will join again next week to hear the second part of the webinar. Thank you so much for your support.
Thank you, everyone.
Okay, and one last thing. There's nothing we haven't heard. Okay, so never be embarrassed to ask us a question. And anything you say to us stays with us. Okay.
All right. Have a great night, everyone.
Good evening.
Thank you.